This video will explain how to record bond transactions when a company issues or sells bonds. A corporation records bond transactions when it issues or redeems bonds and when bondholders convert bonds into common stock. This video will focus on only the issuance of bonds. Bonds may be issued at face value, below face value, which is a discount, or above face value, which is a premium. Bond prices are quoted as a percentage of the face value of the bond. Face value is usually $1,000. A $1,000 bond with a quote price of 97 means that the selling price of the bond is 97% of its face value, or $970. A $1,000 bond with a quoted price of 103 means that the selling price of the bond is 103% of the face value, or $1,030. To illustrate the accounting for bonds issued at face value, let's assume this company issues $100,000 of 5-year 10% bonds on January 1st. The entry to record the sale is a debit to cash for $100,000 and a credit to bonds payable for the same amount. Bonds payable is reported in the long-term liabilities section of the balance sheet because the maturity date is more than 1 year away. Over the life of bonds, companies make entries to record interest. Interest on bonds payable is computed in the same manner as interest on notes payable. If we assume that the interest is payable on January 1st, then this company accrues interest of $10,000, and that is found by taking the $100,000, again that represents the par value or the principal, multiplying that by the interest rate of 10%, and in this instance time is 1 because it's for a full year, so the interest would be $10,000. This company would record the following entry: a debit to interest expense for $10,000 and a credit to interest payable for the same amount. The company classifies interest payable as a current liability because it will be paid within the next year. When this company pays the interest on January 1st, it will decrease or debit interest payable for $10,000 and it will decrease or credit cash for the same amount. Now, let's assume that interest is payable semi-annually on January and July 1st. In that case, they must pay interest of $5,000. That is found by taking the $100,000, multiplying that by 10%, and then multiplying that by time, which in this case is 6 months out of 12, or 50%. On July 1st, the entry for the payment, assuming no previous accrual of interest, is a debit to interest expense and a credit to cash for $5,000. At December 31st, they recognize the $5,000 of interest expense incurred since July 1st with the following entry: a debit to interest expense and a credit to interest payable in the amount of $5,000. When they pay the interest on January 1st, they will simply decrease or debit interest payable and credit or decrease cash for $5,000. In the previous example, the contractual, also referred to as the stated interest rate, and the market, also referred to as the effective interest rate, were the same. The contractual interest rate is the rate applied to the face or par value to arrive at the interest payment. The market interest rate is the rate investors demand for loaning funds to the corporation. When the contractual interest rate and the market interest rate are the same, bonds will sell at face value. Interest rates change daily. As a result, the contractual and market interest rates often differ. To make bonds saleable when the two rates differ, bonds sell below or above face value. When a company issues 10% bonds and the market or effective interest rate is 12%, investors will not be interested in buying the 10% bonds unless their value falls below their face value. When a bond is sold for less than its face value, the difference between the face value of a bond and its selling price is called a discount. If the market rate of interest is 8% and the contractual or stated interest rate is 10%, the price on the bonds will be higher than its face value. When a bond is sold for more than its face value, the difference between the face value and its selling price is called a premium. Issuance of bonds at an amount different from face value is quite common. By the time a company prints the bond certificates and markets the bonds, it will be a coincidence if the market rate and the contractual rate are the same. Let's illustrate this concept using some additional numbers. AT&T is issuing 100 bonds at $1,000 each for 10 years with a stated or contractual interest rate of 10%. These bonds will pay $10,000 in interest per year. If this company issues 10% bonds when the market rate of interest is 12%, investors will not be interested in buying 10% bonds unless the selling price falls below their face or par value. Investors expect a $12,000 interest payment, and this company is only paying $10,000. As a result, the selling price, which is $88,529, will be lower than the face or par value of $100,000. The difference between these two amounts is called a discount, and in this example is $11,471. If the market rate of interest is 8%, but the contractual interest rate on the bonds is 10%, investors will have to pay more than the face value for the bonds. This company pays $10,000 in interest when the market expects $8,000. As a result, the selling price, which is $113,592, will be higher than the face value or par value of $100,000. The difference between these two amounts is called a premium, which is $13,592. This slide does a fabulous job summarizing what we just discussed. To illustrate the issuance of bonds at a discount, let's assume on January 1st, this company sells 100,000 5-year 10% bonds for $92,639. Interest is payable on January 1st. The entry to record the issuance results in a debit to cash for the amount received. In this instance, it's $92,639. We will always credit bonds payable for the face value or the principal. In this example, it's $100,000. The difference between these two numbers results in a debit to discount on bonds payable, and again, the difference between these two amounts is $7,361. Although discount on bonds payable has a debit balance, it is not an asset. Rather, it is a contra account, which is deducted from bonds payable on the balance sheet. The $92,639 represents the carrying or book value of the bonds. Now, let's assume this company issues these bonds at $108,111 rather than $92,639. The entry to record the issuance is a debit to cash for the amount received, which in this example is $108,111. We always credit bonds payable for the amount due at maturity, which is the face value or principal. In this example, $100,000. The difference between these two amounts results in a credit to premium on bonds payable in the amount of $8,111. The company adds the premium to the bonds payable so that the sum of these two numbers, $108,111, represents the carrying value or the book value of the bonds.